There are two camps that can never agree on how to properly invest. There are the ones that try to time the market, that try to buy the bottoms and sell the tops, and there are the people that just set and forget, that say it's impossible to time the market is efficient, simply just dollar cost average in your favorite assets. So buy, say, the S&P 500 every month, buy Bitcoin every month, and just accumulate no matter what the price is. Now in this video, I don't try to resolve this conflict. Instead, I rather want to combine this. Is there maybe a way to buy into the market regularly and adjust this dynamically to get more out of every dollar invested? For example, here, let's have a look at Bitcoin. We're also going to look at the stock market in a second. At the top, we see the long-term Bitcoin price. At the bottom, we see its drawdown from the all-time high. Wouldn't it make sense to buy more in a specific month when we have dropped already by 60, 70, 80% from the all-time high, and to potentially buy less when we are very close to the all-time high? So we use this as an oscillator. We buy more when we have dropped from the all-time high, we buy less when we are close to the all-time high. How well would such an approach work? Intuitively, it should work quite well. The issue though is when we are at an all-time high, we tend to see a continuation of the rally. So we might not buy enough into that rally. So how much does it really make sense to wait for a drop? I have run the numbers and I've done this for Bitcoin. I've also done this for the NASDAQ 100, so for technology stocks. This again comes from Bitcoin Strategy Analytics, so that's the backtesting platform available to the premium members of this channel. And what we see over here, that's the Bitcoin price. It starts in 2018. This is where I started my investment journey, and it goes all the way to today. And at the bottom, we've got our indicator. We buy more when we have dropped from the all-time high, and we buy less when we are close to the all-time high. And of course, we buy something in between. We buy our typical amount when we are just at the average drawdown. Now, how do we define a drawdown? We are not looking at the entire history of Bitcoin. We simply just look at the last 5 years. This is historically how long a cycle took, 4 to 5 years. And so that way we can also encompass potentially the maturation of the market, right? A drawdown might be less severe in the current cycle compared to, say, 2 cycles before. 2 cycles ago, we maybe dropped by 90%. Now in a bear market, we maybe drop by 70 or even just by 60%. And so we're just looking at the maximum drawdown in the last 5 years. That's what this 5.0 years here stands for. And then now let's compare. How is our portfolio developing over time? Constant dollar cost averaging versus dynamic dollar cost averaging. How much are we dollar cost averaging here? How much are we buying? The answer is $1,000 every month. So I think that's a quite reasonable amount. That's what many people can save. And if you started in 2018 with that strategy and you just bought $1,000 every single month and you did not dynamically adjust, you would have gotten this amount of Bitcoin. So that's the line in gray. And you would have gotten this amount of US dollars. That's this line here in gray. If you, however, had dynamically adjusted the buying and selling using the drawdown from the all-time high, then you would have gotten the line in orange. So that's more, obviously. It's more Bitcoin, it's more dollars. But how well did this work? Let's have a look. So we had 99 purchases of Bitcoin of $1,000 every month, and that then turned out to be roughly $500,000 from 2018 to today. Roughly is important here because with constant dollar cost averaging, we now have 457,000, but with dynamic dollar cost averaging, we have 639,000. So that's a delta of $182,000 or almost 40%. The maximum drawdown of our portfolio is pretty much the same. When we are close to the historical drawdown compared to the last 5 years, we buy $2,000. So the median purchase amount is again $1,000 roughly. The average buy amount is exactly the same. So this is what this calculator is optimizing for. We need to have the same amount invested. And instead of owning only 6.4 Bitcoin, using dynamic dollar cost averaging, we own almost 9 Bitcoin. The average cost basis moves from $15,000 to only $11,000. It's almost 40% more units. So I think this is quite encouraging. Of course, the majority of the additional gains over just static dollar cost averaging, they come from the very first bear market. So we buy more during the first bear market. The second bear market doesn't have that much of an impact anymore because we already appreciated that much after the first bear market. So during the second cycle, we already have that large of a portfolio that additional $1,000 or $2,000 per month don't really move the needle that much anymore. So that's what we can see in this chart as well. We have quite a lot more Bitcoin in the first 3 to 4 years, but then with the second cycle, where Bitcoin again drops by more than 70%, we still outperform the static dollar cost averaging. We still get more BTC, but in percent, the difference isn't really that much anymore. Really, the main gains are to be made at the beginning by not buying too aggressively at the all-time high, but by instead buying much more after we have dropped from the all-time high. Currently, by the way, we are over here, so we should be dollar cost averaging slightly above our typical size. So not just $1,000, but maybe $1,200, $1,300. Have a look at how the data changes when we add another cycle. So we don't start in 2018, we start in 2014, an additional 4 years, and here is the data. So again, we buy much more aggressively after the Mt. Gox and Silk Road collapse. We buy much less once we have hit the all-time high. We thus miss out a lot on that additional rally from maybe $4,000 to $20,000, but then we buy back in much more once we hit the 3.5K. And so it oscillates around all-time high and drawdown from the all-time high. Still, it gives us more BTC over the long term, and the vast majority of the gains are made when aggressive purchases occur during a bear market, when Bitcoin comes down. That's when we make most of our additional gains. And then of course our portfolio gets to a value where an additional $1,000 a month don't do anything anymore. This is here a portfolio value of close to $10 million. The delta here between dynamic and constant DCA is 3 million US, or 42%, which by the way is very comparable with the delta with just one cycle. So really, again, we do see that dynamic dollar cost averaging makes a lot of sense at the beginning, and once our portfolio value is very large relative to our monthly contributions, doing it dynamically or doing it statically doesn't really change much anymore. Now, what about the stock market? What about, say, the NASDAQ 100? There is a case to be made that maybe technology stocks are currently very expensive, and maybe we are entering a bear market. And since we are close to the all-time high, maybe right now we should be dollar cost averaging less into technology stocks. So this is the scenario. Bitcoin was created here at the vertical line. This was the .com crisis. This was the global financial crisis. Since Bitcoin was created, we never really saw a major correction. We can barely see COVID on this chart. And when we look at the NASDAQ relative to the S&P 500, we are currently very close to the all-time high just before the .com crash. We didn't accelerate into this AI bubble as quickly as we did during .com, so maybe the market isn't as heated, even though the valuations are comparable. But still, technology stocks make up much more of the entire stock market valuation compared to just a few years ago. And so when we work with that scenario, when we say that the currently high prices might deflate again and the AI bubble was to suddenly pop, does this have an impact on our dollar cost averaging strategy? Let's talk about .com. At what point did it become more clear that maybe technology stocks are overvalued? For example, there was Alan Greenspan, the head of the Federal Reserve at the time. He held a speech addressing irrational exuberance on December 5th, 1996. So 4 years before the bubble burst, it already looked like things were heated. So that was over here. It's very hard to time those rallies and tops, but let's work with our dollar cost average simulation prior to when the market got completely heated. So we already buy in before, but then we buy in less as we are close to the all-time high, and we buy in more as we crash. What happens when we start buying, when even the chair of the Federal Reserve got skeptical, and he was early with his criticism? Here's the result. Again, Bitcoin Strategy Analytics, the backtesting platform. For the premium members, we again have our 5-year look back window. We invest $1,000 every month. We start on the 5th of December 1996. We go all the way to today, and this is how that develops over time. We buy much less during the dot-com hype, we buy much more after the implosion, and we gradually buy less and less as we approach the prior all-time high. And then we buy again quite aggressively during the dip that happened in 2023. And so this is then our result. We've got much less Nasdaq 100 accumulated prior to the crash, but then once the crash played out, that's when the purchases got very, very aggressive. And so what's the delta here of $1,000 every month since 1996? So that's roughly 30 years of data. The delta is a bit over 1 million US dollars. Instead of having 3.4 million, it's 4.5 million. It's again 33% more. And we've got a very similar result to dynamic dollar cost averaging in Bitcoin. In Bitcoin, it's 40%. In the Nasdaq 100, it's 33%. And again, the vast majority of those additional gains come from buying more aggressively in a crash. We do not have to time the crash perfectly. We just have to be a bit more cautious. Again, we start our dollar cost averaging over here. We are not starting it over here and just buy super cheaply as we crash down. This is not the optimal time to start this backtest. Had I started the backtest over here, then the dollar cost averaging would outperform even much more. But nobody can time this perfectly. Nobody knows if we are currently already very heated. Maybe we see another run up, and maybe it takes some time until tech stocks come down. But if we work with the assumption that at some point technology stocks will come down again, because historically the price to earnings ratio is very, very high. This year was .com, this year was the global financial crisis. If we work with the assumption that prices don't always go up, but at some point prices can correct, it does make sense to be a bit more cautious with our dollar cost averaging into the Nasdaq 100 right now. Again, we are close to the all-time high. We have not dropped by 80%. We have not dropped by 55%. And we are not trying to time the market. We are not trying to project what will happen. We just look at what did happen. How much did we already fall below the all-time high? Is that drawdown as high as it has been in the last 5 years? If the answer is yes, we buy aggressively. If the answer is no, and we are close to the all-time high, we buy very, very conservatively. And that brings a lot of advantage in the first years when starting such a strategy. That's true for Bitcoin, which is shown over here. That's also true for the Nasdaq 100. And it can take a few years until things play out, especially in the stock market, since cycles are longer in traditional finance. But it does pay out quite nicely over the long term, right? $1 million more with the exact same amount invested. I think that matters. The drawdown duration for dynamic dollar cost averaging, by the way, is also much shorter compared to constant dollar cost averaging, simply because we buy much more aggressively and the recovery is thus also much stronger included in our portfolio. I think it still makes sense to have some allocation to stocks, to not be completely out of the market, but I also think it makes sense to rather start with a more cautious approach and then scale this up as our drawdown from the all-time high for the Nasdaq 100 increases or prices simply fall. So if we take again our 5-year look back window, we'd start to fully engage with dollar cost averaging, so to buy with $2,000 instead of $1,000 after we have fallen by roughly 39% from the all-time high. If you got some value out of this video, feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. Feel free to also check out the premium membership. This is where you get access to the tool, to the backtesting tool. This is also where I share my own trades, where I share how to navigate the market. Thanks for watching and see you next time. Cheers.